Hey all, this is Billy with Harnessing Your Wealth. This is going to be a fun episode, a little different here, where I'm going to have a turn in the hot seat. I'm going to be the guest. So as you can see to my right, here's my son, Cade. Cade's going to be the interviewer, and he's going to ask me a bunch of questions. So I'm on the hot seat. I'm going to turn it over to him.
Thanks for having me. Looking forward to this show today. We're going to be giving you guys a fun episode. We're going to dive into one of the chapters in Billy's book, From the Starting Gate. We're going to look at chapter 10. It's called A Time to Sell. For those of you that have already read the book, already diving into this chapter, that's okay. We're going to give a lot more detail and context around the chapter. And for those of you that haven't read the book, it might be a good reason for you to dive into it and purchase the book on Amazon if you haven't yet. So
Yes. Buy the book.
Buy the book. Okay, A Time to Sell. So right now, as many of you know, there's a lot of volatility in the market. There's a lot going on politically, causing people to have some nerves. And we've been getting calls. We've been getting people that are a little concerned, and also people that want to add money to their accounts right now, which are the calls we like getting the most. So there's five reasons in this chapter that you have listed out of why you might want to sell, or why you would justify selling. Those five are: 1, rebalancing; 2, goal funding; 3, valuation; 4, taxes or other obligations; and 5, performance. So you mentioned in this chapter, early on in the chapter, that you might consider rebalancing once per year. So maybe expand on what a rebalance is and why you would maybe want to rebalance in a time like this, or why you wouldn't.
Well, rebalancing is really just an act of selling back to the original allocation. If you had planned in your retirement account or your 401k, for most of you, that makes more sense because you can understand the fund and the lineup that you might have in that account. You originally set it. Let's say, for example, you have 50% in large cap funds and 30% in mid and small cap funds, and then let's say 20% maybe in fixed income funds. Well, as time goes by, you're going to typically have those balances get out of whack, because some funds might be outperforming and other funds might be underperforming at any given time. So in recent years, if you would have owned the large cap growth stocks, those have been on a much longer term growth trajectory than some of the other allocations. So you would have had that get stretched into a larger percentage of your total. A rebalance means you're going to trim that back to the original 50%, which would sell high. In other words, sell high and buy low. So the fixed income piece may have fallen to only 15% over the last few years because it has not kept up with the performance. So what we'd be doing then is adding more at a lower price. And that's really rebalancing. We get into rebalancing occasionally because it forces you to bring things back into their original selected allocation or risk tolerance. So it brings us back to that buy low, sell high. We don't advocate doing that all that often, and sometimes people try to do it too much, but that's one of the reasons why we would sell.
Sometimes want to let the winners run, right?
I love winners, and you can't cut the legs out from the winners. So you get a good holding and a good fund or a good stock. You want to see those things, let them spread their wings and fly. You keep cutting them back too often, they don't ever reach their full potential for you.
Mm-hmm. That kind of leads me into the next point here, which is goal funding. It's one of the most important parts of retirement. It's being able to fund your goals. I like the comment in the chapter that says retirement isn't a one-time event. It can last 30 or 40 years longer, and you have no way of knowing precisely how long it will be when it starts. Some people get the idea that they're going to retire and then they're no longer an investor, but that's not the case. So share with our listeners how you would come up with the funds for a goal for a client while in a down market like we're in right now. Would you sell the stocks or funds that are performing the worst, get them out of the portfolio? Give us some context there.
Right. So goal funding is just what it says. You have a goal. Goal might be to fund a child's college education, or it might be to purchase a second home. And for most people, the number one goal is retirement. They want to be able to live the rest of their life in comfort, have some financial stability. So with that, instead of contributing to your retirement, you're drawing from it. You're taking distributions from your retirement. And the distributions can matter. They do matter, how you take those distributions, especially when you get into a declining market or a down market. So no, we wouldn't want to sell the equity holdings in a down market. We would want to draw from more of the fixed income or the more stable type holdings that have bucked the trend a little bit in the near term. Allow those equity funds time to settle and rebuild and grow, and then take those distributions from equities. So for example, the last several years, the markets, equity markets have done quite well. Now, during retirement, we're drawing from those equities. So you have to take money somewhere. And in a portfolio of mutual funds or even diversified portfolio of stocks, retirees need the cash. They want to take a distribution to fund their lifestyle. So in order to get that, we're going to be selling something. It's not just a dividend check. So some people have a hard time figuring that out, but that's our job. People that have invested in real estate, for example, or own a rental home, they only think in terms of what the rent check is going to be. But for us, it's different, and it's way more liquid and easier to create the distribution from the appropriate area of the portfolio. If you owned a rental home, you can't sell part of a house to fund your retirement. You just have to receive what the market will pay you for that rent. But with an investment portfolio, it's all liquid. So we can sell any portion of it we want, invested in the types of securities that we advocate, which are liquid. So if something comes up and then there's a larger need that month, we can create that by selling a little more. With retirees, we always have what's called a withdrawal portfolio. So we have a little bit more in the cash holdings, short-term money markets and short-term investments that are more stable. So retirees have access to that capital. We want to make sure we have 6 to 18 months sometimes of liquid holdings to fund those distributions. Even when we get into a declining market, we're not going to disrupt those distributions.
Yeah. On the flip side of that, when we're in a bull market like we have been, we are going to be taking more from the equity portion because they've been running up. So that's good context there. And something that we've talked about recently is capitulation. I don't think a lot of people know what that means, but in layman's terms, it means giving in against your better judgment. How does that impact our investment portfolios?
Time I got into this business, it was 1996, and we were at the kind of the tail end of such a great bull market. In other words, a positive market for the stocks. And a lot of people were getting invested leading up to the dot-com bubble that burst. Dot-com was just becoming a thing. The internet was emerging. Online companies were coming out of the woodwork. So it was a time of speculation and a period of craziness in people's attitude. And then we had that correction. And it wasn't really a correction. That was my first experience with what can happen on the downside. And I had studied markets for pretty much my whole life. So I knew that markets and stocks had volatility. There's exposure there for ups and downs. And we hadn't seen a negative or a decline for quite a while. And the returns year by year were getting so stretched and so many people were wanting in that I felt like this isn't normal. This can't continue forever. And I feel like there was a correction that should happen. The correction that actually happened was much more severe than most people anticipated, especially for the technology companies, the NASDAQ companies. The NASDAQ is the indice that holds most of the securities with the 4-letter symbols. And by and large, historically, it's been the technology and the biotech and the startup kind of growth companies like that are housed by the NASDAQ. So the capitulation question looks like this. People want in when everything's going up and everybody's making money. And sometimes people capitulate into the upside. So they get they own CDs, for example, or they own very conservative investments. And then they see and hear all these great stories about so many people making a fortune. And then they decide to buy. And that's the capitulation because they give into the emotion of greed. On the downside, it's much more pronounced because more people, you find out, are unwilling to ride through the negativity or the headlines or the fear. So they give in to the fear of, I'm going to lose everything. And the capitulation on the downside is sad. It is super sad because people that get out just when they should be buying, they never get back in, at least in my experience, because they don't have the stomach for it. They realize that they feel good. They got out of the boat. They got off the ride at the amusement park. They couldn't handle it. But I'm not talking about when you're investing, it's like some thrill. I'm not trying to suggest that. It is a long-term endeavor that you have to have the stomach and the mindset for it going in order to be successful. And if you don't on your own, then allow an advisor to help you. Because the people that turn to themselves for guidance, they look in all the wrong places. They look at the media, their social media, their friends, who are, by the way, typically the worst people to listen to with regard to investment advice. The worst, because they got their information from some other source online who just wanted to get online and flap and talk and provide really no basis for recommendation. So very few times do I see people get good advice from colleagues or family members. They're always late to the party. They're always the after fact, way behind the times. But the capitulation is sad, like I said, because they get out, they don't get back in, and they fail to reap the rewards of long-term investing. And that's what we see. We use as a gauge as advisors. I learned this early in my career, is I would watch certain clients, and I knew when they got to that point where they wanted out, that's when it was the peak opportunity. That's when the market was set to take off again. And it's sad, but you find clients that are like that you can basically gauge the rest of the investment world based on their mistakes. They're always at the absolute wrong place at the wrong time.
Yeah, it's sad, but they can't get it figured out because it'd have to be worse in order for them to justify getting back in. But emotionally, that won't make sense for them because they're still going to be nervous about the market.
Yeah, they get out, and you think, okay, rationally, you get out because why? Because either you think everything's going to zero and never coming back, or two, you think that you're going to get back in at a better price. Now, be honest with yourself if you're listening to this. If you get out, then you're wanting, which is a sick thing, you're wanting the economy to get killed. You're wanting stocks to go down further because then you're justifying your own actions.
Then you're right.
Yeah, then you're going to be right. But if it gets worse, what are you going to say? You're going to just pat yourself on the back and say, I was right. I'm so smart. My advisor's so stupid. And it gets worse. But do you get back in? Nope.
Never do.
Never. You never get back in because now you're justifying that it was a great call and nothing's going to be good again. But the market snaps back just when you close your eyes for a second. Bam. It's back and it's way beyond the price that you got out. And now everybody's looking really smart to have stayed in or who bought during that period. And now you're mad. You're mad that you got out and you were tricked and the market's stupid. And now you're going to do nothing but badmouth it, probably for the rest of your life.
I lost all my money in the stock market.
Lost all my money. I've heard that so many times. And it's just a fool's way to describe it because they don't know what else to say in that situation. Rather than say, I made a mistake, which is owning up to it, which is the bigger person to own up to a mistake. No, they want to be the victim and say it was somebody else's fault. So that right now there's a good example. This is getting political. So everyone wants to blame Trump for everything that's happened in the market, which, by the way, the tariffs did cause this. That was the catalyst to create this recent downturn in the market. But something was going to cause this downturn. The market needed a correction, just like I talked about. When valuations get stretched, markets need a correction. This is going to set up America for a lot of prosperity going forward. Mark my words on this. This is going to be a good thing. So please don't just sit and watch the media and the news reporters who just bash on Trump day in and day out or bash on Musk, because what they're doing is trying to find ways to save us, the taxpayers, money, and potentially cut our taxes and make more money for America. It's America first, which is what I love. If I have a leader of an organization or any business that I invest in, I want that leader to put that company first, to make the shareholders wealthy, not to look at their own greed and their own personal objective for what they want out of it, is what they're going to do for everybody else who's part of that organization.
Yeah. A little short-term pain. Hopefully, eventually, I think it will be positive for the country.
This is great. This is great. This is reset. This tells us a lot about the fortitude of a lot of investors and where they're at, because you know you're going to have these corrections from time to time. It's emotional for a lot of people. And you see some of them react in a very negative way. We try to do our best to guide them through that. But these are the times when you make your money. This is the time when the market has less risk than it did when it was at an all-time high. You know, people think in reverse. They think it's an all-time high, everybody's investing, everybody's happy, there's no risk in the market. That's when there's the most risk, guys. But every time there's been a major sell-off or correction or crash, they love to call it a crash. That's just a scary word. You haven't lost anything. Remember that. You see your value of your statement, sure, it's down, but that doesn't mean you lost anything. You lose when you sell. Please don't misinterpret what I'm saying. The value is down, but you haven't lost. You lose when you sell. The values are still, you still own the shares. Remember that. You still own the shares. And just because the short-term valuation decline means nothing if you're a long-term investor. You have a chance now to buy more shares.
Yep. Markets are fragile in the short term and resilient in the long term. One
It's
of
a
my favorite
long-term,
quotes. Yep.
long-term process. It's a weighing mechanism. Okay, it's long-term. You're going to see what really matters.
Mm-hmm. There are some positives to find in a down market. One of them is the buying low opportunity, and the other one is from a tax standpoint. So we talked about rebalancing, and you're going to have to book some gains. So that's always a conversation that we have in-house here. What advantages can be had from a tax standpoint during a down market?
Well, real quick on the taxes. No one likes taxes, by the way. But the government doesn't exist without taxes. So remember that. Those people who want more and more government, you got to remember, more and more government means more and more taxes. Somehow we have to pay for it. Somehow we have to pay for the government to operate. And I, for one, do everything I can to help our clients avoid taxes. So we don't want to send money to the government. I don't like doing it. There's ways to avoid paying taxes if you're smart about it as an investor. Occasionally, you're going to see a market like we have now, or you're going to have a few securities, for whatever reason, have stumbled, have fallen on hard times, had a bad earnings report, something that draws that stock price down for a period of time. Maybe it's temporary, maybe it's a few days. I've seen stocks have a negative headline, drop off a couple of days, and then bounce back because the headline is proved to be false. But if you see yourself in a predicament where you have a few holdings that are down in your portfolio, and I'm talking about either mutual funds or exchange traded funds or securities like stocks, you have the ability to capture that loss. You can capture that and use that as a tax loss for that for that year's tax return. So to offset gains that you might have. So that's called tax loss harvesting. We employ that tactic here for all of our clients when necessary. The trick is you don't know what that stock is going to do in the time period when you sell it to when you can repurchase it. Now remember this is important. If you're going to engage in tax loss harvesting, there's a rule called the wash sale rule, which Congress enacted in order to eliminate day trading in and out just to capture tax losses. They are trying to help the long-term investor take advantage of these tax loopholes, if you will, by saying you sell one for a loss, you're going to wait 31 days to repurchase it. That means you're not just engaging in and out for tax reasons, right? We don't advocate that. remember, we're talking about long-term investing. And if you were to buy a business, if you just stop thinking about publicly traded stocks, if you're just looking at private companies and you're going to start a company with one of your friends or some family members, you're not thinking about buying shares and selling shares the next day. That's silly. That's day trading. But yet people in public markets think that's a great idea. I think that's such a foolish idea. You don't make money in the trading part. That's a bad idea. The only time you want to sell like that would be for a tax loss harvesting and then re-engage, and hopefully, if things work out, you can repurchase those shares at a price that's at the same or lower than where you sold them, if you still like that company. And you should like it. If you've done your research and the stock's still down, you should like it even more.
For sure. So next segment here, similar to baseball, a baseball player might be judged on their batting average or their on-base percentage. We're kind of judged on how our investment models are performing. So performance is a big part of why a client might stay here or transfer their accounts here. It's like golf, where one stroke or 1% makes all the difference. So give me a little bit of insight on what would cause you to want to sell 100% of a stock or a mutual fund in one of our investment models.
So in our models, we are always looking at the company. We're always looking at their industry, seeing if we're overweight, underweight, about right in what we believe to be the fundamental outlook for that industry in light of the economic situation that we find ourselves in. Sometimes we find ourselves a little too exposed to a certain area. And I'll use the example of technology last year. We found that with the growth of the portfolio and with the companies that we had in the technology space, we were getting heavy. We were getting lopsided in technology. We decided to make a tactical move and sell a couple of the fringe positions that we liked but didn't love. So we wanted to sell them. We took some gains, booked those gains, and redeployed that money into other sectors of the economy. We started to buy some energy. We started to buy some consumer staples. So getting more what's called defensive in what our outlook would be going forward. We knew that there was going to be a potential correction and that technology usually has the largest decline, at least temporarily, because of their high-flying PE ratios and growth projections. So they go up faster, they come down faster than other sectors of the markets. We just want to be a little more defensive. So that's one example of taking an entire position out. Another example is in the unfortunate situation you find that the management of the company has engaged in fraudulent activities, things that you don't expect or can't foresee. But I've had that experience a couple of times in my career, one being Enron, one being WorldCom. Those are before your time. Mm-hmm. But many of you who are listening to this, if you've been around any length of time, you remember those back in the late 90s, early 2000s, companies that engaged in manipulation, financial doctoring of their books, and the companies suffered drastically as a consequence. So you have to find those. You have to find them as early as you can. Whenever there's hints of fraud or hints of cooking the books, you want to be nimble there. You want to do deep digging to make sure that you're not just falling into a trap, but you also want to make sure that you don't ride that thing right into the ground. So there's been a couple of examples like that where we've had to move out of a position.
Mm. Kind of going out on a limb here, but what about a political reason to sell a security? That's a big one right now.
Yeah.
We've had a couple people concerned with certain companies and if it's ethically a company that they want to own. How about that with our investment models? Because I know there's a couple that we have that we might not agree with.
I mean, I would just say it. It's Tesla. Tesla's the number one company right now that's the culprit. And I don't even like where it's coming from, because I would say it's more about their own moral standards. Is like ethics is, to me, is not the question. Ethically, you see Musk, who is being a volunteer essentially for this Doge organization, the Department of Government Efficiency. Well, the left has declared him to be a dictator, anti-democracy, tearing apart the U.S. economy. And I kind of I wonder, where is that all coming? Well, the media is spreading that. It's 100% propaganda. Bear with me. If you don't agree, just please listen to me. He's getting paid nothing. Why is he doing this? And then we hear also that he's stealing Social Security from people.
They're trying to tank the economy. He's lost more money throughout this market sell-off than anybody.
Oh, yeah. But they say, well, that doesn't matter because he's the richest man in the world, blah, blah, blah. I guarantee if you're listening to this, if you were the richest man in the world and you lost half of that value, you would see it and you would feel it, and it would matter to you. It doesn't matter how much money you have, because all of us started out somewhere. We were teenagers at one point. We had $1,000 to our name. That mattered. If you lost 50% of that, okay. Now you have, let's say, millions of dollars, tens of millions of dollars. You lose half of that. What do you think? Does it not matter? Because, hey, context says, heck, you started, you only had 1,000. You know, why do you care about losing 4 or 5 million? You still have 4 or 5 million. I promise you it's relevant to your situation. So he's lost more in this endeavor than anybody. He gets paid nothing for it. The waste that they've found, the abuse, the corruption that they've found, I feel that all of us as taxpayers and citizens should be at least tuned into that, at least engaged in saying, what's happening? Where are they finding this? How is this possible? It's interesting to me that a lot of people just buy into the government line. They believe the government, hook, line, and sinker, that the government is 100% honest, reports the truth, never lies, is doing the best with all of our money, and we all pay the taxes and they do what they want with it. I'm not a big fan of that. You know, Rome fell based on the same kind of philosophy. Even back to the times of Jesus, when Jesus was crucified, and you watch and hear about the stories in the Bible of the thousands or tens of thousands of people who actually stood and cheered that on. And you think about how sickening we all feel thinking about that event and the tragedy that occurred because of the government deciding to execute Jesus Christ. You know, I'm not trying to say this is the same standard, but I'm trying to put a context around people's ideologies and people's thinking, that they fall into the line of the government thinking, and then they believe that everything they do is just and right and correct. I have a hard time with that one. Yeah, that one bothers me a little bit. I think Musk is coming up with some ways that's going to save our taxpayers, us, you and I, a lot of money. And why wouldn't we want that? It's crazy to me to think that people are upset about that. Stop and go through that in your own mind. Process that one a little bit, please. Because the rhetoric is baseless. There's no fact behind it. It's just regurgitating what the media tells you to say.
Exactly. I think the problem that people have is that he's not an appointed official or an elected official. And
he's not elected.
There's a lot of people that have not been elected that have had a lot of power. Anthony Fauci, enter chat.
Anthony Fauci shut down the entire world. All right? Please put that into context, because it's complete hypocrisy to say that Musk is an unelected official who's running the show when we just went through what we went through with COVID. And you guys have listened to us before, you know that we disagreed with nearly everything that happened out of that. And to shut down the economy, to create the inflationary spiral that we've had, to have to shut all the supply chains down. I mean, that reset the entire global economy. And we're still dealing with that today, even in how we transact business, even in how we engage with one another. We're still dealing with that. And so much of it was foolish. I don't care. I'll take that to my grave, guys. Let's debate it. But that is beyond the objective for what the government was intended to do. Protect the people, but don't control, don't manipulate, don't change the narrative for whatever reason. We can go into that another time, probably for another show.
Mm-hmm. There is a quote in your chapter 10 that I really like. It's about what we can and can't control. So I'll read it for you guys. God, grant me the serenity to accept the things I cannot change, the courage to change the things I can, and the wisdom to know the difference. how is this quote impactful not only to the world of investing, but just to everyday life?
Sometimes you just have to stop and get quiet in your own mind. I find that the noise can disrupt your logic and your thinking. Your conscious mind thinks it's smart all the time, and that's for all of us. But it's the subconscious mind that can tap into the universal wisdom and universal intelligence. And that's all-knowing intelligence, where there's things there that we don't really understand, but we can if we allow our minds to get quiet and just to realize what's being said and what's true and what's not true. The markets are going to struggle. Every so often, you're going to see a correction, and you can't predict it, and you don't know why, but there's always a reason, and people flip their lid on whatever it is, okay? And you usually want to blame somebody for it, rather than just looking at it and say, what good could come of this? What are the positives? What are we laying? What is the foundation that we're laying and building toward? We all know that what's happening here, these tariffs, is because of the unsustained trajectory of the debt that we've incurred. How did we allow politicians to take our tax money and spend them so foolishly that they've racked up a $36 trillion debt for us and for the children and our children's children to somehow figure out how to pay? Gosh, this is beyond belief that people don't look at this and have concern about this. We're allowing government officials, elected politicians, who most of them are clueless. I mean, it is maddening to watch how many of them have zero knowledge about the economy, finance, business, anything. But they're out there wanting to bark for more money for whatever cause they're going to take up the flag for. Just remember this. In 1929, the market, going through this great recession, we call it the recession, the biggest recession of all time, stocks dropped 89%. People thought that was the end of the U.S. as we knew it, right? Manufacturing dried up. People were out of jobs, homelessness. 1974, stocks dropped 48%. 1987, 23% drop. 2002, remember I was talking about that dot-com bubble, but it started in 2000 and finally ended in 2002. The markets dropped 49%. I say the markets, it's S&P 500. 2009, we had the real estate bubble. That collapsed. Brought stocks down with it, 57%. In 2020, we had the pandemic. Scared the hell out of everybody. Mm-hmm. That was a really quick drop, 34%. Now it snapped back. The reason it snapped back so quick was because the government unleashed unbelievable record amount of stimulus or printing of money, which was a problem. Now remember, we didn't have to have that correction like we did because it was the reaction to the pandemic. It was the scaring of everybody, using the media to scare them, to change the narrative, to put more control in the government's hands, and then lock everything down, and then print money to make everybody feel good about it. And this is just insane behavior, where everybody likes it. They're high in the hog. We're spending money we don't have, but everybody's fine. Everybody's happy, and politicians are saying it's good. 2025, here we are again. We're down 15% or so in the market. People are losing their mind because they don't know. It's like this never happened before. Stocks are going down. Trump's evil. Trump's an idiot. He doesn't know what he's talking about. And then they're putting posts out there that Trump is in charge of the biggest market declines in history. Guys, that doesn't have any context. That's just another media push for more attention. Whenever something gets more valuable, higher and higher in value, the point drop loses its meaning. Okay? We need to deal in percentages. So if the Dow's at 30 or 40,000, it drops 5,000 points. It has much less impact than if the Dow is at 10,000, it drops 5,000 points. Holy crap, that's not hard to conceptualize. But so many sheep just jump into that line of thinking. They see that posted on social media and that, boom, they're going to repost it and say, Trump's crushing the market every time he gets involved. And he owns the biggest drops in the market.
Something you said yesterday to a client that I'd like to share. I really enjoyed the comment, and it was, I think everyone listening can agree that Trump probably has the biggest ego that we have ever seen.
No doubt.
Probably the biggest we've ever seen. Why do you think he would want his reputation to be crashing the economy, crashing the stock market? That is not at all what he's trying to do. He's trying to level the playing field, and he wants to leave a good reputation for not only himself, but for his family. So please don't buy into that. That's the media trying to stir the pot.
Yeah.
Not true.
This is 100% right. His ego will not allow him to leave office with a reputation of destroying wealth. He's America first. He's always said that. He said that in his campaign. That's why he was elected. That's why the majority of the population voted for him. And he's doing exactly what he said. There's no surprise here. He's doing exactly what he said he was going to do with the tariffs, with the border closures, with all of the funding of different programs that he's starting to try to eliminate, deporting illegals. Exactly what he told us he was going to do. So it's not a surprise. But all those different drops that I was talking about, what I was going with that is they've all recovered. Every single time there was that fear that, investing is bad. They've all, every single time set a new high from where they were. So I always tell people to invest. Invest when it's hard. Invest when you're emotionally struggling with it. Think about this. You put $500 in the S&P 500 in 1929 and left it alone. It's worth over $1.7 million today. That's just $500. And so I think we can kind of all agree that there's a lot of money to be made. Did we get through all the 5 reasons to sell? Only reasons, only 5?
We did. We got through all 5. Also wanted to dive in a little bit about Warren Buffett.
Yeah. What
he's doing. We got a lot of questions about what's going on with Warren Buffett. Historically, the buy and hold investor, long-term mindset. He raised a lot of cash. Let's talk about that.
He raised a ton of cash last year, and a lot of people are scratching their head thinking, once again, Warren Buffett has lost it. He doesn't get it. He's too old and senile. We're making a fortune. AI is the wave of the future. And we talked about that multiple times in the office because Warren's not even invested in some of those high flyers. His biggest position was Apple. And Apple's kind of become more or less the poster child for quality investment. Like it's a standby. It's one of the largest owned companies in the world by a lot of people, by a lot of pension funds and retirement accounts. And Warren was one of the largest owners through his company, Berkshire Hathaway. Last year in the fall, he started trimming the position. And he sold, I believe, 60% of his position in Apple for a huge, huge profit. Mm-hmm. And of course, it raised a lot of eyebrows. Like, what is he doing? What does he need cash? Is he dying? Warren's not one of these guys that says, well, I'm dying, I'm getting old, so I need to sell all my stocks, which is another fallacy that we hear clients say, right? You alluded to that earlier. You don't just sell your stocks because you're getting older. You might trim your allocation to the types of stocks or have a little more fixed income. You don't just liquidate all your stocks. He raised that because he felt like the economy might be heading for a slowdown, and he felt like stocks were getting stretched. And he's always stuck to his principles of value matters. Where value is matters. Now, a lot of our clients can't digest that because when you sell something, you have to pay tax if you have a profit. And we hear that all the time is, damn, you guys are killing me with the taxes. And so we don't like to just trip taxes all the time, especially if we're long term, because I believe Apple will go back to where it was and then surpass that, even beyond that, eventually again. But looking at what he's done, you have to respect him. He's done extremely well over time. I just kind of looked up his performance. If you had invested just $1,000 in his company when he took it over in 1965 in Berkshire Hathaway, $1,000 has grown to over $18 million today. It's just wild. Now, I would ask any of you who don't maybe look at stocks as a good place to be, or real estate is your choice. Buy me a piece of real estate you could have bought in 1965 and put $1,000 into it. It's worth $18 million. Buy me that, because I'd really love to know if it's out there. Please call us or email us. Tell me if that happened.
Yep. And we're not bashing real estate. We own real estate.
For sure.
But as far as a long-term investment goes, it's hard to beat.
I just like the liquidity, and I like what stocks offer for us, which is low cost. Don't have all these extra fees and taxes. So if you just own Buffett stock for all those years, you didn't even pay any tax. You haven't sold it. The beautiful thing is he sold all that Apple internally in the company, and the shareholders didn't have any of that. You know, in a mutual fund, if the mutual fund manager sells the security for a profit, for example, if they sold Apple, then the individual shareholders of that fund are going to receive a 1099 and have a pass-through tax associated with that gain that was booked, that realized gain. So they have to pay that tax as part of the mutual fund. With Buffett's company, Berkshire Hathaway, he sells this, it's part of the conglomerate, it's part of the company. So they pay it at the corporate level, they pay the tax. That didn't get passed through to the shareholders. You can buy that stock. Essentially, it's a company that can do whatever it wants. And what he does is he buys other companies. So he's an investor. He doesn't manufacture stuff directly, maybe indirectly through all those other businesses. But it's a great way to build long-term wealth. You know, a company like that, that's just, remember, he gets it. And he avoided a lot of the dot-com stocks. He didn't buy all the hype. He avoided all the real estate collapses where everybody else got really smart. And we talk about this too, this is a big one. He avoids like the plague anything has to do with crypto. Mm-hmm. Any kind of Bitcoin, he said that this is a fool's gold. This is created out of thin air.
Rat poison
squared, what Charlie Munger called it. But, you know, and again, people say he's foolish, crazy, doesn't get it, doesn't understand it. Well, he readily admits he doesn't understand it, nor does he want to. So I think that's one of his rules of investing. When you don't understand something, stay away from it.
Maybe just to wrap this up, give a little elevator pitch on why people could benefit from reading a chapter like this while the market is struggling.
Well, again, people get in these kind of times and they don't know who to listen to. They start turning to other people and they can make really, really bad decisions. I've seen that in finance, and I've seen it in health. I've seen it in a lot of different walks of life with people making the wrong decision, the wrong choice. And then it's almost irreparable harm of what they do. So I advise people to take different viewpoints, analyze them yourself. And again, go back to that subconscious quiet place in your mind. Get quiet, not just for 30 seconds. I'm talking about, might take you several weeks, might take you sitting down and just closing your eyes and just stopping all the noise for a while. Turn off the news, stop listening to the social media feeds, because you're just getting bombarded with everything that you like, everything that you believe to be true. So you're not seeing anything different. You're not looking at different opinions. You're not considering if you're getting the whole truth and nothing but the truth. You might just be getting portions of it, or mixed feeds, or taking everything out of context with what's happening and what's going on. That's the sad part. The media is guilty as hell of creating fear and spreading lies. And I've learned that in my career, guys. Please stop with it. You've got to open up your mind to all different sorts of information and digest it, bring it all back to the table, and then sort through it on your own. Remember, long-term investing isn't for the weak. You have to be invested for a viewpoint of a long period of time. If you're 60 years old, you're probably going to have a 30-plus year retirement. Does that mean all of a sudden you go into money market funds and CDs? Well, good luck staying up with inflation on that. You can't just look at flipping the switch and going all to something super safe when you get in retirement. You can't stay up with the cost of living. Eventually, your funds are going to dry up because you're drawing out more than they're growing. And just a few more examples, Cade, that I'll leave with is I love to share stories and use examples of long-term investing. And these are just businesses that are very well-known. Everyone's been there, done that, shopped at their stores or bought their product. But very few, as a percentage of the total population, took the step where they said, you know, I really enjoy this product. What if I invested or became a part of that business. It's so easy. Buy shares in the company. If you love that business and you know it's doing well and everybody around you supports it and it's a great company that has good growth potential, what's wrong with buying some shares in that company? Here's the example. Walmart went public in 1970. It went public at $16.50 a share. If you had taken just $1,000, and believe me, $1,000 would have been very easy for most people to acquire, to have, to buy shares in that company. Bam. Buy shares in the company, you would have ended up with 60.61 shares at that IPO price. It's split its stock 11 times since that date, which would create or transform your 60.61 shares into 124,121 shares. At today's stock price, those shares are worth $10,618,569. Remember, $1,000 turns into $10.6 million in roughly 55 years. Hello, again, show me another piece of real estate that did that. And also, don't forget the dividends, because Walmart pays a dividend every year, and at the current number of shares that you ought to have, you're going to be receiving nearly $117,000 a year in dividends. Now, add that up over the lifetime of that investment, you're talking millions. Here's another example. How about Coca-Cola? That's been around for over 100 years. There's a very long-term company. 1919, Coca-Cola went public at $40 a share. So you could have put $1,000 into that. Of course, it would have been a little tougher to have 1,000, but still, it's not an unreal amount of money. Might be the equivalent of having 10,000 today. So you put $1,000 in it, you end up with 25 shares. Those 25 shares, after all the splits that have occurred, are now 230,400 shares. That's crazy, right? But that's exactly what's happened. And at today's stock price, those shares are worth $16,054,000. Plus, you're receiving $470,000 a year in dividends. Amazing for a $1,000 investment. I just love these stories because people can grasp what's happened. And this is not just me cherry picking. You can go through any good business that's been around for 20, 30 years. Like, for example, Apple. I mentioned earlier, it's a tried and true business. It's a staple in our society. Almost everyone knows what an Apple phone is, an iPhone. But it went public in 1980 at $22 a share. So you put $1,000 in Apple back then, you would have had 45.45 shares. Go through all the splits that have occurred. You now have 10,181 shares. At today's stock price, 180. Your $1,000 is worth $1.8 million. And that's such a much shorter term than I just described in those other businesses. So will Apple then sooner or later surpass the 10 million mark like Walmart over a 55-year period? My bet would be yes. You know, they're an innovator. They're a frontline company in technology and what we do as a society. So these are examples of buying and holding. Remember I said the money is made in the waiting, not in the trading. And these are the examples I try to instill in people is don't get excited about short-term news. The news will destroy your thinking and your ability to think. Turn it off. Listen to your advisors. Listen to your inner thinking. Understand why you're investing in the first place. And if you see the value and the market is down 15% or some of the stocks that we're talking about are down 20, 30, or 40% or more, hello, maybe this opportunity is knocking on the door that you could be investing right now and taking advantage of these prices.
Well, I hope you guys enjoyed the show today. Long one for you, but I think it was very informative. So if you have any questions or you want to chat with us, get in touch with us on our website or give us a call here at the office.
Appreciate it, Cade. You did a hell of a job. Tune in again next time, guys. Thanks for joining us.
Thanks.
Thank you for listening. For more information about today's show, please check out the show notes. Visit our website at www.petersonws.com or give us a call at 801-475-4002. Peterson Wealth Services is a registered investment advisor. This is a paid-for advertisement. Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of a personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Peterson Wealth Services.